Welcome, everybody, back to Risk. Today we have Mr. Michael Oliver back on our channel. Mr. Oliver is a phenomenal chartist and analyst, and it's a privilege to have him back here. And it's such great timing because so many good things and interesting things are happening in the markets. How have you been?
Been great. Yeah, and you're right. Big things are happening.
So why don't we get right into it? Why don't we talk broad market issue here? Equity markets versus commodity markets.
Yeah, momentum structural analysis that I found, it was 1992. It's 30 years. And before that, I was in the futures market. But I've not seen any such coincident and inverse behavior among major asset categories that are colliding with one another like icebergs that create wave effects up or down ever in let's say 40, 50 years. I think we're in that situation now where if you're in a given market, you really don't need to focus just on it. You need to focus on tangential markets that could be inverse or coincident with your market, because the wave effects are terrific. And our focus right now is on what we think is now going to be somewhat the standout leader for the next year or two at least. And that's gold and related. They're for silver, gold, and silver miners. That's not always been the case. I mean, there have been plenty of times where they've been a good situation, and so have, let's say, commodities in general, or even the stock market might have been coincident with the directional movement of the gold market. What's going on in the stock market really has our attention, because if you'll just go get an S&P chart, like a monthly bar chart, simple thing, go back to 2000 or whatever. But you go from that 2009 bear low, which, we thought was the end of the world, right? Everybody thought there was, there were all kinds of real world ramifications, and not just 1%ers getting hurt, but everybody got hurt. Okay.
Yep.
But that was a trivial bear market from a trivial bull market peak, relatively speaking. The bull market that led up to the 2007 high had only been 3 or 4 years old. And it had only taken the S&P up, triple or so. Okay, we've been in a bull market now, S&P, through late last year at least, from March of 2009 to then, dozen years. That has taken it parabolic off the page. 12 years of upside with some sharp intermittent declines that last usually a month or two, and then they're out of the way. And you wonder why. Say, oh, gee, the economy must be great and robust. And all the metrics, of course, are distorted by a declining value in the money unit. And money unit is often used as a measure of how to measure these various economic metrics, like what are retail sales? What are the corporate sales year over year? Well, they're measured in dollars, but the number of dollars out there is just exploding.
Yeah, so you're really not getting a true measure of those.
No, it's having a yardstick that's made out of elastic,
Right. No, it makes sense.
Measure anything objectively. Even Ray Dalio, a very famous non-gold bug asset manager, Bridgewater, I think 6 months ago came out with a statement that said, quit looking at the price of your stock and look at the underlying value of your money. And in other words, he's shifted his focus. He realizes there's something wrong here. And he's not the only one of major.
You think he's going to become a gold bug soon?
Well, in effect, he is. And a lot of these guys are, and they're not gold bugs, over decades. They do it because they assess something has changed. And I think one of the things they assess is what Dalio said, the underlying value of your money unit. And if you look at an M2 chart from the Federal Reserve of St. Louis, you can go online and get it, download it, look at it on your screen. And it put it on that S&P chart. It went upward curvature, okay? But since 1959, the M2 has doubled in supply of money units every decade, basically, 90 to 100% double every decade, ongoing. So that chart is an upward curve. But since February of 2020, money supply has gone up well over 40%, just in 2 years. You want to extrapolate that out a decade, it's a parabolic, in other words. Okay, that's an interesting metric to look at when you overlay that S&P chart. It sort of explains, why did the price go up? Well, why, since I was a kid, is the price of a loaf of bread gone from 15 cents to, et cetera? It's not because there's a wheat crisis. over the last 50 years. It's because the money unit is degraded. Okay.
As the packaging has shrunk on everything as well.
Yeah, exactly. You get the price of anything has been affected by that. Then there's another chart to get from the Federal Reserve of St. Louis, and that's the Fed funds rate chart. You can download that. And while M2's done this, Fed funds rate's done that, collapsed off the page, and for a dozen years has laid at effectively zero. Had a little blip up to 2.5 and then back down, and now it's upticking again. But basically, when you look at that chart going back 50 years, it's just a staircase to ground zero. And so for a dozen years, it's laid there. No wonder the S&P went parabolic. Okay, so you have a bubble, an asset bubble, that was mostly determined by monetary policy, the central bank. But then there's another factor people don't take into consideration, and that's guys like Ray Dalio, who are asset managers, who can take their shovel, so to speak, and divert that river flow someplace other than where the central bank might want it to go. And admittedly, for the last dozen years, asset managers have chosen the stock market and been rewarded. But a lot of them haven't.
Can I just interrupt you for 1 second here? I mean, there's been such a shift sociologically in our society where we went from professional managers managing money back in the 60s and prior. Then the federal government enacted, the whole 401k system, and people started investing money on their own. Vanguard has grown tremendously. I suspect that those social factors have been at work, and perhaps what you're seeing in the market is indicating a shift away or into something new that we're going to be entering in.
Well, the popular ETFs, and instead of running it by a professional fund manager who might have objective skepticism over the last year and therefore started to move money out, a lot of individual investors have just gone with the glory. ETFs and Vanguard and other funds have had major ETFs in those arenas that have satisfied the itch. So yeah, there's a herd effect because there are mechanisms for it now. You don't have to pick your own stock. You can just throw a dart and oh boy. But nothing goes up forever, especially if the reason is that shallow, that one-dimensional, namely monetary policy and free money. Okay. So ultimately it reaches an excess. And when markets reach excesses, anybody who's been in markets long enough, whether it's a downside excess or upside, when it flips the other way, sometimes it goes excessive the other way, to cleanse itself. And we've seen a lot of bear markets. The dot-com bubble, was a huge collapse of 80-90% for the Nasdaq 100. And then we saw the 2007-2009 bubble break. That was real estate primarily and financial institutions. But now we've got a bubble that is just, there's no comparison. And by our metrics, and we don't mean price, we measure things by long-term momentum studies. We use our own, what we call structural analysis of momentum. The S&P and the Nasdaq broke down in January and February. We also measured the 3 prime stocks of the last several years that had been leaders, meaning that their percent weighting is so terrific that they constituted like 20% of the S&P and 40-50% of the Nasdaq. And that would be stocks like Amazon, Apple, Google, Microsoft, et cetera. And our annual momentum metrics of those stocks have broken down in the last 2 months or so, meaning that the trend of the last dozen years has been broken in terms of momentum trend structure. Normally, momentum will break trend, go up or down prior to price following suit.
I think we need to emphasize this point because what you're talking about here is not just a short-term change or shift in the markets. You're talking longer term, and it's much more significant than most people realize, correct?
Yeah, we're not looking for trading turns that last for 2-3 months. And the other factor that people need to take into account is historically major bear markets in the stock market, with one exception. 1929 began with a crash and then had a 50% rally back to the high, and then it entered an arduous arm wrestling bear market. Bear markets, if you look at the 2000 top through 2002, or the 2007 peak versus 2009 are arduous arm wrestling matches. You'll get a 20% drop and you'll get a 5 or 10% rally, and it'll tease everybody, and then you'll get another drop and then it'll rally. But all the way down, it sucks you back in with hope. I think we're getting one of those rallies right now, for example. But by our metrics, the major trend structures of too many key indices, and of course, the leader index has been Nasdaq 100. It's definitely beat the S&P, and it turned down first, and the S&P turned down in February by our metrics. We think the process has begun to unravel these bubbles in the normal way, meaning not a crash. So don't expect a March 2020 event. In fact, you look at the March 2020, sure enough, it didn't lead to decline. It led to upside. Okay. Now, the problem is that the underlying assets, underlying trend determiner here, the central banks, not just the Fed, monetary policy, quantity of money, interest rate levels, is heavily influenced by the behavior of these key asset categories. If they see the stock market in real trouble, not just a dip, but where they deem it to be, this is of concern. And when they see individual investors and asset managers also express real concern, then sentiment changes and the Fed has to take that into account. A couple other asset categories to watch in this regard in terms of the downturn. Muni bonds, and there's a good ETF to watch on that, MUB, and junk corporate debt or high yield corporate debt. There's a couple of ETFs there, HYG and JNK. And by the way, those particular symbols, the Fed actually bought them outright in the spring of 2020 through 2021. They were buyers of these ETFs to hold them up.
So basically the plunge protection team was active.
The fund protection team was in play, not just increasing lowering rates and money supply growth, but in actually buying the ETFs. Now, since they ceased buying, those ETFs have started to melt down. And if you compare like a JNK chart or an MUB chart to the S&P, you'll see something far more stark on the downside in terms of meltdown.
Okay.
Now, there's a point at which the Fed is going to have to panic over these assets because it affects municipalities, state governments' ability to fund themselves, pension fund, et cetera. So all this talk about Fed going to fight inflation with higher rates, I sit back with a bag of popcorn enjoying the show because it's going to be very interesting as these assets that they want to preserve start to come down to levels that alarm them and investors, whether they can maintain that so-called new policy direction. And I think the victor in all this is going to be gold because ultimately they're going to have to revert back to a soft money policy to defend these asset categories, or just watch them burn. And I don't think they'll do that.
So what's your take on the precious metals market?
As an alternative to the stock market, I think that's what they are now. Now, sometimes they've been in sync. There have been periods of time when the stock market's gone up. The inflationary pressures have also driven gold up between, like, for instance, 2000 through 2011, gold went up, so did the S&P. And in 2011, they divorced. Gold went into a bear market. Stock market continued up. But over the last few years, if you'll look at like weekly charts of the T-bonds, T-bond futures, and gold, they've been in sync with each other, meaning T-bonds rally as an alternative to a decaying stock market at given points in time, and gold rallies too. But even that other alternative, if you're an asset manager wanting to park money outside the stock market, you say, well, I've got to put it in a safer place. I'm going to buy T-bonds. That doesn't work anymore. Mm-hmm. Gold and T-bonds were in sync with each other up through March of this year when they both made lows together, March of 2021, when they both made bear market lows together and turned up. But since then, T-bonds have melted, coincident with the stock market, meaning yields have risen, prices have gone down, and gold's gone up. That means that what? If you're looking for alternatives to a decaying bubble, stock market bubble, what are your choices now? It used to be T-bonds and gold. Now you're pretty much left with gold. There's a popular notion, a lot of popular notions are wrong, There's a couple of them that are real obvious right now I want to point out. One of them is that linkage between if the stock market goes down, then, oh my gosh, the gold miners are going to go down. Why? Because everybody remembers March of 2020. When the stock market had been collapsing for several weeks in February and finally in March, there were 6 days at the tail end of that collapse in the stock market where GDX and other gold mining ETFs collapsed as well. There was an overlap for 6 days. And it was sharp, very sharp drop. But as soon as that was over, the stock market made its low, GDX exploded back up. And by the summer of 2020, GDX had gone from like $16 to 45 or so. Okay. Stock market had a nice recovery, but nothing compared to that. Silver had gone from like $12 to 30 in that 3 or 4 month period between March 2020 and the summer of 2020. Look at what's happened since December of last year now. You go back and you'll find there's a high in the Nasdaq 100, high in the S&P.
Right.
Nasdaq dropped about 22% from its peak trade in December, early this year, to its low recently.
I'm sorry, I'm looking at my charts back behind you.
And if you look at that, you say, well, gold miners must have dropped, right? No, gold miners went up almost 40% during the same period of time, while Nasdaq 100 dropped over 20%. So take that myth, set it aside. Something else is going on here. Another thing that people like to look at, and it's been a false leader, totally false. If the dollar's strong, that hurts gold. Dollar's weak, that helps gold. Yes, at some point, the dollar weakness, and we will see it, I think, major weakness coming up. But the dollar since 2015, December of 2015, was at $98 index now, I'm speaking of, was at 98.65 at the close of that month. Again, December 2015. You know where it's trading today? Either side of that number, 6 years later. Okay, where's gold since December 2015? That was its low monthly close of its bear market. It was at 1,060. It doubled. So without any help from the dollar, gold doubled. If you're waiting on the dollar to give you a clue when to buy gold, you missed a doubling. So put it aside. Gold is smarter than most of these markets. I think it's looking at that huge macro picture of the ongoing degradation of money. It knows that if these other asset categories begin to crumble, the ones that the Fed determines it's okay if inflation takes stocks up, that's okay. We don't call that inflation. But when commodities—
Same thing with the cost of education and housing, right?
What hypocrisy. And people pay attention to it still. It's going to be fun to watch the Fed go into a spiral here, an academic policy spiral, because if they continue on the course of raising rates, they're just going to demolish that bubble. And they'll be blamed for that. And of course, they won't do that. There's be a certain point where the word caution that has been in a lot of Fed speeches over the last few months will come into play. And they'll have to say, well, there's a new factor out here now. Suddenly unemployment numbers don't look so good, or suddenly retail sales don't look so good. All these metrics that are, that they like to look at. So they'll have an excuse. We have no doubt of that. So that's why, for instance, go back to June of 2021. Mid-June, that's when the Fed meeting occurred. And that was the first time they used that word taper. And they beat the hell out of gold. Mid-June, for a month or two, they dropped it well more than $100. It approached in early August its March 2021 low, but didn't take it out. That March 2021 low was 1673. They actually dropped under 1,700 in the August sell-off of last year. Again, the selling due to the Fed policy change. Mm-hmm. Gold went back up again. Then again, there were like 4 sell-offs in gold of $100 or more that were all redundant. Where gold again gained what it lost, and they hit it again, they'd hit it again. They never could take out the March 2021 low. So finally, gold said, that's it, I've had enough. And we shot back to the highs.
Right.
So, and silver went from 22 up to 27, and it's now 25, 26.
Michael, is it fair to say that because we had such a long period of consolidation between that point and now, that signifies something very big to come and something of a very long tenure? in the gold and silver markets?
I think so. I think you're right on that because, and again, another thing that people are looking at, while you're talking about the correction phase that began in summer
Correct.
2020
Yes.
for both metals,
Yes. Running through
gold
here.
went into a range with a maximum drop was 20% from its high. March 2021 was 20% off the high of summer of 20. And then it lived in the middle of it. Silver dropped from 30 down to 22 repeatedly, couldn't gain any further on the downside. Now it's back up in the middle of that range. Commodities exploded, and we put out a report, and it was October of 2020. We said commodity explosion coming. Well, it hit all commodity markets at once. Basically, you could throw a dart, sugar, copper, you name it, and markets that had no relationship suddenly exploded. That's not because of a specific fundamental. That's because of monetary shift, meaning asset managers said, hey, look, I'm a little skeptical of this category, the stock market. I'm going to put money into commodity related stocks and commodities because they've been beat off the page. They're not going to go to zero. The risk reward is better. And sure enough, it was.
Mm-hmm.
They had a lot of money. Commodities exploded, but they didn't start exploding until October 2020. Gold had already doubled. So people who are arguing, well, why isn't gold going up if commodities are in inflation? Gold was ahead of the event. Gold leads these events. It doesn't follow them.
One thing that always fascinates me about following charts is you look around to what's going on in the world and you can see it in the charts too. I mean, there's a fundamental shift globally, and it's a much more dangerous time throughout the world, and we're having a lot of issues with supply chain and everything else. And I think we're also seeing that in charts. Would you agree?
I agree. And there's, in fact, there's a couple of charts we can look at that sort of make that point. Let's look at silver first. There's a price chart of silver. Okay, that's weekly closes. And on the extreme left side, you'll see March of 2020. That's when silver plummeted down, actually traded down closer to 10, but the low weekly close was around 12. Okay, and then it exploded. Intra-week got up almost to 30. The high weekly closes after that explosion over 4 months went from just above 12 to 28. That was the surge that broke silver out. Okay, that made a statement that said, I'm no longer, I'm joining gold. And since then, week by week, it stayed in a range. The red line, by the way, is a 3-quarter moving average. To explain what that is, at the end of every quarter, we average the prior 3 quarters of price action. We come up with a new average. It's sort of a lumpy way of measuring what a 200-day average is. It's about the same duration. 200 days or about in every trading days, about in every 3 quarters of a year. Okay. Anyway, as you can see, price exploded and that average came up to price. And finally, price broke below that rising average last summer. Well, why last summer? That was shortly after the Fed said taper. Okay. So silver had a break from the 28 level. In fact, the peak weekly close there prior to that break was at $28.14. Okay. Remember that number. Okay. It broke back under that 3-quarter average for the first time in a long time and dropped down near 22. This is in the September of 2021, dropped down near $22. And then went into a new range, sort of in the lower half, what had been the prior range. Well, about 4 weeks ago, price rose above that 3-quarter average. And it actually meant something structurally. If you'll scroll down to the chart below, you'll see what I mean. Here we measure each of those weekly closes and how many dollars above or below that 3-quarter moving average. And as you can see, there's a down arrow, and that was being summer of 2021. That's, again, after the Fed meeting. Price broke below the 3-quarter average, meaning below the zero line. Okay. And sure enough, it was capped at the zero line at 2 different rallies. In November of last year, it rallied up and kissed the zero line, couldn't get above it, fell back down. Then in January this year, ran back up to the zero line. They whacked it again, couldn't get above it. Now you'll notice that we've got a red horizontal line there at the zero line. It goes back to a low in April of 2021. So it's a pivotal structure that's very clear. It doesn't show up on the price chart. We crossed that line about 4 weeks ago in silver when it got back above 24 by much.
So this is basically, is this the same momentum
This is
calculation that you had were in the last chart, correct?
Yeah, the chart above showed the 3-quarter average. That's price.
Right. Okay.
And you broke above it. But on the case of momentum, those highs, which aren't even, on the price chart. There are different levels. On this chart, they're flat at the zero
Okay.
line. We broke through the structure, but already late last year, you could see, early this year, the action emerged above a parallel downtrend channel, another
See
structure.
that? Yes.
So it had an early warning that silver's going to make a turn, and sure enough, it did. So by our metrics, this entire corrective process, as defined by the downtrend channel or by the horizontal, is now over.
Okay.
It's now back into positive trend mode. It's
So
no longer
you must be very excited, because this to me points to the start of something pretty significant in the precious metals market.
I think what it's saying is that the corrective process that you talked about is now over. We're now regained the positive bias that prevailed, that drove silver from like $12 to 28 in 4 months. Okay. We're now back into positive trend. Now go back to the price chart. Now momentum's broken out, so there's not much more it can say. It says, okay, I've overcome a channel and I've overcome a ceiling. I'm out of here. I'm now positive. Price chart has a flat ceiling up there that any price chart idiot could look at, pardon me, and draw a line across. And you can see that back in the summer of 2020, and again in early 2021, and then again in April, May of 2021. So for a year or so, all the high weekly closes were on either side of $28. So it's sort of an obvious ceiling. So obviously, if you ever get above that again, and the number to close above that highest weekly close of that process would be $28.15. Okay.
At that point, I think we're looking for a very explosive rally, correct?
That's what then the price guys are going to say, oh, I'm waking up. This is for real. Okay. Momentum already says expect it. Okay.
Yeah.
But at that point, you get above that $28 level again, and the price guys are going to wake up and they're going to start to join in. Now, gold's already gone back up there. It's gone back to its old price size. And silver, I think, will do the same.
I think at this point, people have to realize the value of the analysis you provide, because right here, it just illustrates it.
Well, hopefully momentum, and usually momentum is ahead of price, and usually it's valid. And It had a very clear structure. And now price also has a structure, but it's up there a bit. You have to pay up to join in the price bandwagon. But momentum already says, go ahead and join in. Okay. Now, the next page is just price. And this is something that long-term investors need to. Now, there's a silver chart, and below it's a gold chart. But let's look at silver right now.
Okay.
We go back 1974. Okay. This is the bunker hunt days. Okay. Silver was trading at $5, $6, $7, and it went up to 50. Now, this chart shows silver on a logarithmic scale, meaning a ratio scale. So you're 1 to 10 to 100 every 10.
I mean, Michael, this to me looks like a classic cup and handle pattern.
Well, yep, I've heard that before, and I think it's right what you're seeing right now. But you can see the dual peaks at 50. There was one in 1980, and then there was the peak in 2011. And then we had the bear market in silver that took us back down to $10, $12. Okay, now the summer explosion, you can see there, that thunderbolt up, and then you went into a range. That's a year and a half or more now of this up, down action. Look at the tone of that price behavior. Look how tight it is. It's not erratic. We think it's erratic when you look at it up close, like day to day, week to week over the last year or so. You think, oh my goodness, this is terrible. But when you stand back and look at it on a longer term scale, it's a pretty tight fist. And if you go back and look through history, like from 2000 through 2011 rally, you'll see a lot of very erratic sell-offs, giant sell-offs that are savage looking. This one is tight-fisted. It's as if somebody's saying, I want this thing. So the demand has been very, very solid at the bottom end of that box. Instead of imploding through it and getting a sharp correction, like some of the corrections we had between 2000 and 2011, this has been tight-fisted. I think the tonal nature of what you see in that red box says something. It says somebody wants this. They know there's more to come. Now flip down.
Okay, go ahead. I was going to say that people are accumulating down here.
Yep.
Yeah.
And despite repeated attempts, in fact, some of those lows at 22 were below 22, and they nip out the prior low by 20 cents or so. And you think, oh boy, they're going to get it rolling on the downside now. They didn't. The demand was just so stout that it just said, I'm taking it. Okay. Now flip down to gold, same period of time, also log scale, ratio scale. And then we go back to when gold was legalized. It's a futures contract in late 74, early 75. You had a bear market that took it from like 200 down to near 100, and then you went up to 850 and so forth. But look at the tonal nature of what we've had since 2020. And we're back up to the highs again, you know. Now look at that 2011 high when gold was at 1900. You'll see that once it made its high, it tried repeatedly to get back up to its high and never could. This time we got back up to the high with a very tight-fisted, again, action over the last year and a half.
Yeah, it's very tight range.
Tight range, indicating, okay, I've taken out the 2011 high, and yeah, I had a doubling to get there. And I rested. I took the selling pressure, but in a very tight-fisted tonal range.
You know, you lose that perspective though when you're following it every day.
Yep, or week to week even. But
you think that, oh my goodness, it's going this way, it's going that way, but you don't realize when you pull back like this, it's a small.
It's you know, from you got to take the long-term investor's perspective and quit looking at it week to week. This chart says a lot, and it's a price chart, and we treat price charts secondarily. But boy, both these charts are saying there's something different this time, and you know. We wouldn't be shocked by another parabolic move here. In fact, in history of gold, if you go back even further than this bull market that peaked in 75, there have been three major bull markets that have been 7 to 8-fold moves in the price of gold. From the bear market low to the next bull market peak, 7 to 8 times what the bear market low was. Well, our last bear market low was $1,050, give or take. Well, 7 to 8 folds is $7,000 to $8,000. That's merely replicating 3 prior bull markets over the last 40, 50 years. That's not even outlandish. That's just saying we'll do it again. Okay.
Right, yeah.
Well, given what's going on in these other markets, to expect the norm is probably to under-expect. And then there's another point to make. Silver. Silver's been a dog compared to gold since 2011. You know, it dropped much more percent-wise. In fact, it hasn't gone back to its recent highs, okay? But actually, when you measure it versus gold on a percent basis, silver is right now 1.3% the price of gold. If you go back over that same 40, 50-year period, you'll find 4 different times when the price of silver at least reached 3% over, 3% of or more than the price of gold. One time it reached 4.5% the price of gold. And one time it was 6.5%. So there have been 4 times that it's at least reached 3% plus. Our measurements argue that the uptrend of silver versus gold has now shifted back to positive, favoring silver on a ratio basis versus gold. So even though gold is the mama, silver looks like it will outperform gold in the next year or two. Well, good grief, if it just goes back to a normal 3% over gold ratio, you can do the math. If gold ever went to 7,000 to 8,000, silver would be $240. And that's just replicating gold doing a normal 7 to 8-fold bull market, which is done 3 times before, and silver going back to a level it's been 4 times before in the last 40 years, 3% of gold. So while we favor the gold as the mama market, we more favor silver and the gold and silver miners over gold.
And based on what you said earlier, you suspect that the gold and silver miners are not going to follow the broader equity markets, and you do not have a good outlook on those, correct?
Correct. And in fact, again, like I said, go back to December, look at the S&P and the Nasdaq, what they did from high to low. Nasdaq had over 22% drop, in fact, from high tick to low tick. During the same time, GDX went almost up 40%. So it took that sharp sell-off in Nasdaq and said, no, going up. So it broke that so-called model, which really isn't a model. It's a rare exceptional memory of March 2020. And it was also one period of time in 2008 late when stock market had been collapsing and gold joined in October 2008 briefly. But that's the exception. And also just, flip up a chart, for example, of Newmont Corp, which is the largest gold miner out there, largest blue chip stock of the blue chips among the gold miners.
Sure. Yeah.
If you're a large asset fund manager, you don't buy the penny stocks.
No.
You don't do that for policy reasons.
Definitely
You
not.
buy
And you know what?
American- Yeah.
Even Michael, even as an individual investor, you got to be very careful of
Yeah.
mining penny stocks because
Oh, they buy things like Newmont because it's
Yeah,
safe,
of
it's
course.
big.
Yes.
Well, look at a Newmont chart. It blew off the page recently, made all-time new highs above the highs of 2020. It didn't just match them, it blew them out.
Yeah.
Okay. Look at the tonal nature of what Newmont just did and what XAU index just did. It went back to its highs. This is the oldest gold silver mining index out there. It went back just like gold to its highs of the last couple of years. In fact, for it, it's a triple high. Been there 3 times. So the gold miners are behaving as if somebody, not gold bugs, but big asset managers made a decision to move. Maybe it's only a single percent of their assets, maybe 5% out of stocks into gold miners. But for the gold mining sector, that's a huge amount of money.
Well, you've been following this market for a really long time, and you know that most of these professional money managers just have poo-pooed gold and silver for the longest time, correct?
Well, and when they change their minds and they make speeches about it, Druckenmiller, for example, and Dalio, and there's more. They don't do it frivolously. They don't do it because it looked good 2 weeks ago. It feels good. They do it based on larger parameters. Many factors are influencing them. And over time, it's not just one event too. So when these guys make a shift like that, they're going to stick around. And the evidence is in the tonal nature of what just happened to the gold miners over the last 4 or 5 weeks.
Okay.
It tells me that large investors are moving into that tiny little sector and are likely to continue.
And I mean, based on the length of time that consolidation we've lived through has been, this is here to stay. And as you said,
you're not chasing a market. No, you're not. If you buy oil now, you're chasing a market. In fact, we got long oil at 40. We suggested major long. And we had a target of 105, maybe, it blasted to 130, and it could likely stay volatile in a range. But the problem with commodities now for the world markets and for the central banks is it's not the issue of whether they go higher right now, because a lot of them have really had parabolic type moves recently, but their annual momentum trends are young. Usually when we see a change in an annual momentum trend, like S&P did the downside, or commodities the upside, it lasts a couple of years, minimum, sometimes a lot more.
Mm-hmm.
Commodities just turned up in late 2020. They're a year and a quarter old on an annual momentum trend. Yes, they've shot up a lot percent-wise, and some of them are overheated. But the problem is that even if you have they cheered the drop in oil from 130 back under 100, we thought support would be in the 90s. Sure enough, it is. We're back over 103 now. That if you stay up here, you don't have to go any higher. Just hang around up here in wheat, in corn, in copper, et cetera. You're starting to choke off certain economic metrics. You'll have a recessionary global effect without even going higher. Just hang around. And yes, it might stop for a while, and we suspect that wouldn't be a surprise. But then gold has already stopped. It stopped a year and a half ago, and it congested. It paid its dues. They tried to beat it up repeatedly. They had fundamental story to beat it up with, and the fundamental story didn't work. The tapering, the rate rise.
Right.
Instead of selling off and being in the 1700s, we sell off when we're in the low 1900s. Get the message? Okay. So, anyway, I think, yes, after that consolidation, now gold and silver are on their own could again take off again without the commodities having to participate at this point in time.
Well, what do you think of the longer term oil price? I mean, do you think that we're in for
I think that
a bloodbath?
I don't know that, there are people throwing up numbers like $200 now. Okay. I don't know. I don't have great technical expectations of that. I think it's a bull trend and it could consolidate violently.
Okay.
And therefore, if you've already been long at good risk reward levels, such as $40, for example, it's time to be taking profits on strength and finding something else to get into. And there's several commodities out there that have not gone too ballistic and they've gone into good congestion zones. I'll throw out a couple of them. Natural gas, a very critical energy component. You look at uranium, it's gone parabolic with oil. and that we called it when it was under 20. It's now reached 60 recently. But they've gotten a bit excessive on uranium and oil. And we think you ought to look at that other energy category, natural gas. It wouldn't shock us to see natural gas, which is either side of $5 right now, double.
Okay.
And it still wouldn't even be high in terms of historic prices. Look at sugar. Sugar had a nice run up with most commodities, but for the last year it's gone into a range, a tight-fisted range, around 20 cents a pound. And just
very similar to silver and gold.
Yeah, it's very similar. Like it could have another leg up. So instead of looking at the hot markets that everybody's talking about, look at the ones that have not had that release of compression. And one of them would be natural gas and energy, sugar in the commodity sector, and definitely gold and silver because they've paid their dues. And they said, nope, we've had it on the downside. We're going up again. And they don't need help from commodities. They lead commodities.
No doubt about it. Well, I really appreciate your time today. We've covered a lot, and boy, I just love talking to you. You are a great analyst.
It's been fun. Lee,
Yeah,
thank
absolutely.
you. Thank you for having me on.
We'll see you soon.
See you again.
So I'm gonna edit this. I want to release this Sunday night, I think.
Great. That's a good time.
Okay.
Yeah, good. Thanks, Lee.
Have a great weekend. Thank you again.
You too.
All right. Take care.